Hi, welcome to Edupedia World. Today we are going to learn basic terms of accounting. Please try to understand these words very well as it will help you a lot in building your concept of accounting. Words we have covered today are transaction, account, capital, drawings, liabilities, which would be both current and non-current liabilities, asset, fixed and current both. Now fixed assets are of two types, tangible and intangible. We have covered that also. Receipts, both capital and revenue receipts, and expenditure, all types, capital, revenue and deferred expenditure. Our first word is transaction. So what is a transaction? Any event which has got monetary value and which takes place between the business and any other person, like the suppliers, the customers, the employees of the business, the bankers. And when such event needs to be recorded in the business or for the accounting purpose of the business, it is known as a transaction. Few of the examples are purchasing things for the business, like raw material or stationery or some services for the business, then selling products of the business or the finished goods of the business, then payment of salaries to the employees, then another example would be repayment of loan to the bank. So whenever such an event takes place in a business, it should be recorded in the accounting system and it is known as a transaction. Now the next word is account. An account is basically a statement where we record specific type of transactions or specific category of transactions. In our example, if you see, we have recorded transactions relating to purchase of wood or raw material for our business from a particular supplier and the payment made to that supplier or the balance outstanding to that supplier. So if you see, the first transaction here was purchase of wood, then the second transaction was payment of part amount through bank, and then we have recorded the balance outstanding to that supplier. So similarly, whenever we record specific type or category of transactions in one place or in one statement, it is known as account. Now let's go to next slide. So our next words are capital and drawings. Capital usually means the money with which we start the business or the money invested in a business by its owners. Usually it's in form of cash, but it can also be in other forms like a building put in a business for office purpose by the owner, or a land brought in by a owner for putting up a factory. So whatever an owner brings into the business which has got some value is known as capital. And on the contrary, whatever is taken out of the business for personal use by the owner is known as drawings. Now please understand one thing here very clearly. A business is always treated as a separate person from its owner, and that's why whatever money or valuable item an owner brings into the business is recorded as capital. Similarly, whatever money or goods are taken out by the owners for personal use is known as drawings and should be recorded properly into the business. Now let's understand what is liability, current liability and non-current liability. In very simple words, a liability is anything which is payable or any amount which is payable from a business to any other person. For example, if we take loan to run a business, this loan is payable to the bank again, or we need to repay the loan. So this is recorded as a liability of the business. So a liability is a obligation to pay a debt by the business or a company. Now the liabilities are of two types, current liability and non-current liability. Current liabilities are the amount or the debts payable in a short period or usually within a year. For example, we need to pay our suppliers for the goods purchased. So these are usually current liabilities. Then an electricity bill which needs to be paid very soon is an example of current liability. Whereas non-current liability are the payables or the debts which needs to be paid over a longer period of time. For example, if we take long-term loan from banks, we need to pay it back to the bank in maybe 5 to 10 years time. So it is a non-current liability for the business. Now let's understand what is an asset, fixed assets and current assets. An asset is anything which is owned by the business and has got some value. And the purpose of owning this asset by a business is to make profit out of it or to use it in the business, either for manufacturing the products or for any purpose or for achieving any objective of the business. For example, the plant and machinery, the buildings, the stocks, the cash. So all these things owned by the business are asset of the business or asset for the business. Assets are usually of two types, fixed assets and current assets. First, let's understand what are current assets. Current assets are usually the assets which can be expected to turn into cash within a year or so. These are also known as liquid assets. For example, cash, the stocks which can be sold and converted into cash in a very near future, the money which is receivable from our customers very soon. So all these things are known as current assets. And the assets which are purchased or owned by the business with an intention of keeping it for a longer duration and using it in the business are known as fixed assets or long-term assets. The examples are the buildings, the plant and machinery, the office, the vehicles owned by the business which are used for the business are all fixed assets or long-term assets. Usually you will see that fixed assets cannot be quickly turned into cash. It needs time. It will also interfere with the business operations if we try to turn it into cash or if we try to sell it. And fixed assets are very important for business operations. Now fixed assets are also of two types, tangible and intangible. Tangible assets are the assets which are physically present, which we can see, we can touch, and it has also got value to the business. For example, land, buildings, machinery, equipment, furniture. Whereas intangible assets are equally important, but these are not physical objects. For example, the patents owned by the company, the licenses owned by the company or the business, the copyrights owned by the companies or the business. So these are very important for the business, but it has got no physical presence. It is not a physical object which you can see or touch. A very good example of an intangible asset is goodwill. See, today Apple is able to sell its iPhone at a very high price. No doubt they are selling a superior product, but as a customer, when we buy an Apple product, we know definitely it has got some edge over other brands. A customer has that kind of faith in Apple products. So many a times the business or a company gets this goodwill valued and they put it in their accounts. But can we see this goodwill? Can we touch this goodwill? No, but it has got a value which is very important for the business. So this is a very nice example of intangible asset. Now coming to receipts. Receipts are of two types, capital and revenue. So what are receipts? Receipts are any amount or money received by a company or a business. Now any money which is received as capital from the owners or as loan from the outsiders or bankers are known as capital receipt. These are non-recurring type. It doesn't come to business very frequently or every now and then. Whereas revenue receipts are the amount received by the company by selling goods or services which are recurring in nature, which happens every time, every day, or every now and then. The frequency of these receipts are very high as compared to capital receipts. So any amount which is received from the regular transaction of a business is revenue receipt. It is the main source of income for business. Now let's understand what is expenditure. Expenditure takes place when we buy something for the business or when we acquire something for the business, when we pay or when we need to pay out of the business money. For example, if we buy machines for the business, if we buy furniture for the business, or when we pay salaries to our workers, all these are expenditure. There are basically three types of expenditure: capital, revenue, and deferred. Let's understand what's capital expenditure. It is expenditure the benefit of which comes to us for longer duration or for more than a year or so. This type of expenditure is done for major value addition to the business, like buying new land for the business, new machines for the business, the benefit of which will come to the business for a longer period, more than a year. When we spend for the expansion of business, it is known as capital expenditure for the business. Whereas revenue expenditure are expenditure which is done for running the business, which are recurring in nature, which is essential for the operations of the business. For example, buying raw materials, payment of salaries, paying for office rent. So the revenue expenditure are expenditure for short-term benefit. Then there is deferred expenditure or deferred revenue expenditure. Try to understand this very carefully. Though the nature of this expenditure is quite similar to revenue, but the benefit from this expenditure comes for a period slightly longer than the period covered by revenue expenditure, or it is something we pay for now and the benefit from this expenditure comes later on, or it comes for a period covered by more than one accounting year. A very good example of deferred revenue expenditure is insurance premium. For example, the accounting year is about to end on 31st of March for a particular year, whereas the insurance premium paid is valid till December of that year. So the insurance premium has been paid for 9 months in advance. So though we have paid this insurance premium in this accounting period, but the benefit for these 9 months will come in next accounting period. So this is deferred revenue expenditure. Please do not mix it with capital expenditure, the benefit of which comes for much longer period. Please go through all these terms and definitions once again. Try to understand these properly. Thank you.